Jan-Carel Botha, financial planner at Ultima Financial Planners, was named the Financial Planner of the Year by the Financial Planning Institute. He believes that constant improvement and adoption of global best practices is the essence to staying relevant. He joins us now in studio to share his investment strategies. Well, first of all, congratulations in order. It was announced last night, wasn't it?
Yeah. Thank you very much, Bronwyn.
It's tough. How many financial planners are there?
Well, apparently 20-odd thousand. So
20-odd thousand.
Do they all enter?
I think the process will take 100 years to complete. Then, yeah.
And what does it take to enter? Because I believe it's pretty stringent in terms of what you need to deliver.
Yeah, well, the whole process is a three-stage process. Well, first of all, you have to make yourself available for the judging, and what basically happens in the first round, you actually produce real-life portfolios of clients or financial plans of clients, obviously taking out the confidential details of the clients, and you submit those, and a panel of academics goes through that. From the various universities, looking at the technical elements of the financial plan, and then if you make it through there's another panel that will come visit your practice, and then they will look at your processes. Is there contingency? Is there uniformity in the advice that you give, and so on. And then if you go through there, then there's a final panel.
Do you choose the client?
Yes, you choose it, but the plans and the process will be authenticated in the site visit at the end of the day.
What are you doing right? Because obviously you're doing something right to have won this accolade.
Well, there's a lot of things that you can do wrong, but we try to be consistent in the advice. We try to align ourselves with other experts. And then most importantly, I think, is to make sure, what is it we're good at, and what is it that we're not, and where do we need to outsource certain expertise as the fund management, for instance. With a lot of financial planners, quite frankly, doesn't realize that they're not fund managers. So we try to focus at what we're good at and outsource the rest. Of course, you can't wear all the hats in the industry.
The difficulty comes when you've got to outsource, because this is a question that you're going to get asked over and over again. How do you advise your investors in terms of what fund manager to allocate their money to?
Well, that's a very relevant question, because with 900 unit trust funds out there and 60-odd fund managers, now how do you choose? What's the due diligence that you've done over all of them, and how did you get to that?
Do they check you on this?
Yes, most definitely. So what they'll do, they'll look at, what's your methodology? How do you process from the initial financial plan to the implementation? Because quite frankly, the financial plan, you can run it on an Excel spreadsheet if you're comfortable with that. But that's the first part of the financial planning, is doing the analysis, understanding what the client's goals and needs would be, and obviously where the client needs to go. So there's a whole process that follows there. But then really the rubber hits the road. We need to implement. What's the sort of solution that you look at there? We like to make use of a portfolio advisor to help us in that space, to analyze what's appropriate and have sort of preset solutions where we can just slot in the financial plan into those solutions.
Interesting.
Going back to choosing the fund manager, yes, your methodology, and this again is quite a controversial statement, but surely you've got to judge by past performance, and everyone says that's the wrong way to go about this.
Well, most definitely. We can't even see what's going to happen in the next 5 minutes. So let's be clear on that. So what we would look at, is to have a portfolio advisor that can advise us on the fundamentals of good financial portfolio construction. So looking at the fundamentals and have a flexible solution we can adopt in an ever-changing environment.
Do you go into unit trust, or do you use direct access to the market? Do you generally go for funds?
Yeah, we usually make use of unit trust funds, yeah.
Just in terms of asset allocation at the moment in this uncertain environment, and again, it was another discussion point at the Financial Planning Convention. What would you allocate when it comes to a low yield environment? Would you increase your exposure to passive investments, to index trackers?
Well, I think in the kind of environment that we're in now, what we've been used to in the last 5 and 10 years would not necessarily be what we're heading to. I mean, if we hit a Japan scenario, because
23 years of no growth.
23 years of no growth, and every financial planner would tell you, just stick to the equities, someday you'll make it. So,
did you know that they dropped interest rates to negative? They actually paid you to put money in the bank.
Yes. Yeah, in Japan.
Yes.
Yeah, at one stage. Yeah.
Yeah, so we'd like to believe that sort of function, you need to outsource to a portfolio advisor to look at the fundamentals of the various asset classes. We know them: equity, bonds, and stocks, and cash, locally and offshore, and to have an adequate structure, then to basically be flexible to the various situations that you might enter.
I'd fail miserably.
Would you?
I'd come
financial
totally
planning?
lost. Yeah, because
Why?
I'm quite radical. I would.
Yes, you only go all equities.
All equities and all foreign equities like Nestle and companies like Yum, like Rio Tinto and that, simply because I trust Coca-Cola and Yum and more than I do governments. In other words, I trust them more with my money than with the Spanish government or with any corporate debt. So I'm 100% equities, Jean.
Yeah, well,
so don't come to me for financial planning.
Well,
I think you better go and financial plan him.
David,
maybe help them a little
We
bit.
really try to convince clients to take their money from you to put it with us.
They're going to do it after tonight.
What about other asset classes, as we were touching on now? So how do you feel about listed property?
Well, listed property has had a good run over the past 2 years. So it's difficult. I mean, cash is doing nothing. I mean, equities, except for the run that we had this year, but last year 2 or 3% in equities. Cash is doing nothing, as I've said. Bonds is a dangerous space to move in, and a little bit of listed property that we had, and clients are looking to outperform inflation by 4 or 5%, So it's really tough. But I believe, and as the portfolio advisors will tell us, there's some pockets.
So what's your goal? I mean, what do you look for when a client comes to you now at the moment? And I would assume that most of your clients are near retirement or post-retirement.
Yeah.
So what do you tell them? Listen, this is what you should expect. What kind of benchmark do you go for? Do you head for?
Well, it's very difficult to generalize.
Well, I think if I take your all-in
you know what?
growth,
Let's see if you can help David here. If David came to you, how would you help him?
Old.
He needs
I'm very old.
no, but he needs help because remember he's now got this view all equities. So would you
I'm
try and encourage him to
100%
Would you try and encourage him to diversify?
Well, what's very important is if you're in a drawdown stage, in other words, in an income stage, volatility does become a major part of the financial plan. So running cash flows, running clients' specific needs, specific cash flow needs in the short, medium, and longer term makes a fundamental part of your decision-making framework at what to implement. So it's very important to realize that a proper financial planner would spend a lot of time in the first half of the financial planning process, which is determining exactly what that client would need, and also determine the level of knowledge and not the aptitude risk appetite is not a word I'm really fond of because people confuse that. A lot of people need to take more than risk than they normally like to. But we spend a lot of time to make sure the client understands and the client needs to buy into that. So.
Phil Billingham was also one of the speakers at this financial planning convention, and he's one of the 50 top IFAs in the UK, and he's coined the term that most investors are actually cautiously greedy.
Cautiously greedy.
Cautiously greedy. They want to make money,
but they don't want
to take on the risk. So do you believe that most investors are cautiously greedy?
Well, we find it over and over again. I mean, we'll have a plan structured for a client, and let's say the agreed benchmark would be inflation plus 4 or 5, and the client would do inflation plus 6 or 7, for instance, over a good term that we had over the past 10 years. And then client would say, but why don't I do 11 or 12% above inflation, as did the very top of the 900 unit trust funds. So in hindsight, all clients are cautiously greedy, but going into the future, they all want to be on the sideline. No exposure to equities, all in cash, the safe places. So.
But generally, I think everything you buy has a very high risk factor. If you hold cash, there's a high risk factor. If you hold bonds today, there's a very high risk factor. if you hold equities, there's a high risk factor.
Most definitely. So what we try to do is we fundamentally try to take a client from point A to point B, in other words, where is he now, to where he wants to go, his goals, and trying to get it from point A to point B with fundamentally what we know at the lowest possible risk.